Good afternoon, traders. This is Christian Roberts, Tribeca Trade Group, and it is Tuesday, December 13th. Risk disclaimer in front of you. Everything that we're going through is for information purposes only, not giving any advice or recommendations. So let's get to today's recap. A couple themes of the day, probably a couple obvious ones too. Nothing really too insightful here in the themes of the day, but we had a gap up today after the CPI data. I think the Qs were up, about 4%, something like that, going into the open. On the first impression of the CPI numbers that came in lighter than expected. So 0.1 versus 0.3 was the month over month number. Ex food and energy 0.2 year over year, 7.1 versus 7.3, and a little bit lower there in terms of actual versus expectations, ex food and energy. So, this was, I think, what for the most part, everybody wanted to see is starting to see inflation come down. However, you've got a lot of events this week, right? This is clearly is not the only event for the week. And, it was one of those situations where I think it was, hey, kind of a gift that, the first data out for the week, was a good one, and I think traders just took profits today and faded the move a bit today. Maybe reestablish some shorts and things like that. So I will go over with you, where the observations and a couple things that stood out to me. But let me just say this because this is something that we talked about in the pre-market session. And if you want the recording, if you're not a member of Tribeca Trade Group, and if you want the recording, I can give it to you. But always, my strategy is when we have a gap up like this, it's if you've got exposure, which I certainly did coming into today, I am a seller. And then you kind of have to wait and see how things develop for the day if you're going to, add any new trades that you might be looking at. But overall, like I always say, I'm going to be a net seller, right? And specifically, I said the first half hour of the day, I'm going to be busy getting out of some risk, and then we'll kind of look around and see what things might be opportunities. But again, to me, it goes with the stat that if you're a regular viewer of my videos, you know that I've talked about before. But the overnight moves, I don't care bull market, bear market, personally to me, but I think since 1993, if you bought the open and sold the close, that you're up like on average 1,100%. If you did it the other way around, where you bought the open and sold the close, you're essentially flat for the same period. So again, 1,100% to basically flat. So days like this remind me of that statistic. And of course, this was really skewed in that situation today, because I think if you net these two together, I think the open for the S&P was up. So the S&P was up 2.8% on the open and gave back 2% of that over the course of the day. So the Qs were up. I could just quickly do that math. There's about 3.8% and gave back 2.7%. Now, again, this was dramatic for the day, but it just adds to that stat that selling the open, and especially on gap ups is something that you kind of learn as a trader over time, right? And it's tough if you're just looking to, again, that's why I'm more of a swing trader than anything else, because if you're just looking to day trade, now, again, a lot of day traders will trade both sides of the market. If they're unbiased, they could go right in and start shorting for the day, if that's what their strategy told them to do for the day. So there's opportunity in doing things like that. But if you're mainly playing things from the long side, very, very difficult, to come in and think that you're going to day trade on a gap up day. All right, so that's the situation for the day. A couple other things, and why don't we go through some of these charts to see where they closed out. Here we'll start with the S&P. So again, ugly looking kind of candle for the day on S&P futures, right? And, again, the closing print is the most important thing when we're analyzing charts. Notice that we did not get back above the 200-day moving average, and notice that we're also stuck inside the value area. So that's so 1, 200-day moving average. 2, we did not close outside the value area. Number 3 is that we're right back into this range again. right? And I made a joke about this I like to joke around. So I don't know where my Twitter page went to, but it's not there. But this was something that I highlighted and on the 1 hour chart, but you could look at this too. I've been doing these curb your enthusiasm type things because, I mean, look at this, right? This is 1, 2, 3, 4, 5, 4.5 weeks where the S&P, it hasn't gone anywhere. And this is really what this market is right now, and it may change, but right now this is buying the dip and selling the rip overall, right? This is not, if you're adding on strength, this is not working in this market. Again, it may change, and that's something that we'll have to watch out for, but it's pretty symbolic of a bear market too. So for now, that's kind of the rules of the game right now, is to be overall understanding that this is a difficult market. It's not a big market for bears or for bulls going sideways for 5 weeks, right? So I always mention this because people seem to sometimes to be enthusiastic on either side. Hey, if we were trending down or if we were trending up, I would be enthusiastic too if if that was my narrative. But really, we've been going sideways, and you could see right now where we essentially, right around where we closed, there's no difference over 5 weeks. So again, I'll continue to post these curb your enthusiasm memes until we get out of this 5-week range. And again, that was the 1 hour chart, but you could see this is what it looks like. I would say one positive is that we are holding above value for the week, right? Which I do like that setup. I would rather see us be above value for the week than break into value or below, right? Because it does mean for the week we're in a trending situation above the value area. But we came in, took out that VPOC, and that's what this looks like right now. All right, NASDAQ. And we'll get to sectors in just a minute, but it's kind of the same thing, right? Where we are right now is where we were about 5 weeks ago. All right. So, again, all I'm trying to do is kind of give you some perspective about what this market has been doing over the last month, a little bit more than a month. It's been choppy, right? And, every time it looks like it's going to break up, it stalls. And when it looks like it's going to break down, like it did, last week, it held in there. And right now, NASDAQ is holding in there at the 50-day moving average. That's acting as support. We are still inside the value area. Small caps, they have been looking weaker to me. You could see that, that's also a very ugly looking candle for the day. We're still inside the value area, but we're also below the 200-day moving average. So for IWM, I would really watch this 180 level or 179.92 and the 50-day moving average. Bonds and the dollar, I didn't think that they were that much to really kind of talk about. I continue to think both the bonds and the dollar right now are not a bad thing for stocks. UUP now decisively breaks below the 200-day moving average. So, again, you could chalk this up for being somewhat bullish to see the dollar continue to break down, right? And if you look at bonds, look at the 30-year bond, right, on the daily chart, right? This is also, continuing to kind of be on the right direction of the shorter term moving averages, and it's above value for the month. Ultimately, I think the 132.27 VPOC can get taken out. So again, the takeaway, because I'm not really trading bonds here, I'm not trading the dollar. But I think right now they're slightly positive for the overall direction of the equities. They're not indicating like risk off right now. Okay, so again, there's just a couple pieces of the puzzle. I don't make all my certainly don't make all my decisions based on what the dollar is doing for the day or what bonds are doing for the day. There's just another area that you can incorporate into your overall strategy. The VIX, the VIX, which I didn't talk about in yesterday's video, because I was just kind of trying to keep it simple, was down 10% today, even though it is still at a 2250. Remember, how the VIX is reacting, because I think it confuses people. It's kind of, you have to think about volatility in terms of, it's easier. The analogy that I always use is a single stock. I think more people understand a little bit what volatility does in a name, option pricing, before a name reports earnings, right? The volatility is really jacked up high in a name that's going to report earnings, because of the unknown event, right? So if you ever notice, for example, if you buy a call option, right, on a tech name or something like that, and the name doesn't go anywhere on earnings, the option, you get crushed in the option premium, right? Because once the unknown event becomes known, right, the volatility comes out. And that's what we saw today as well with the VIX. And you might see that as well tomorrow, providing that if Powell doesn't say anything groundbreaking tomorrow, which is the Fed meeting's at 2, and then the most important thing will probably be, as usual, the press conference, which is at 2:30 and usually runs for about 50 minutes, 50. And if he manages to say something unusual or answers a question unusual, then there may be some type of volatility. But if he doesn't, you will see the VIX decline pretty decently for tomorrow. Okay, that's just how it works, right? A rally, the VIX goes up into an event, and then once the event becomes known, usually the volatility comes right out, right? And not only that, of course, that's Powell's tomorrow, Wednesday, but we've got, quadruple witching, and it's not just on Friday that you have to worry about that, right? Some of today could have been explained by quadruple witching, right? The brokers and the trading desks who manage the S&P and the NASDAQ rebalance, right? They're not just trading on Friday, they're trading all through the week, getting, pre-positioning for that quadruple witching day. All right, a couple things. I'll give you a couple things that I, that I didn't like, in addition to, kind of what we've already talked about. But I really didn't like how, what the biggest up moves were in the beginning of the day. They were things like ARC, higher short interest names, which again, it is not surprising, but it just seemed like things like, for example, the regional banks just did not really get off to that great of a start. They were up a little bit, right? But here's the 5-minute chart, right? Basically real hard fade and never really came back. And they do not look very good, the banks. And my philosophy, which may be different than yours, but I don't think that the banks need to go higher for the market to change from bear to bull. But we don't want to see them break down. The banks breaking down would not be a good sign, and that would be that. I think that would keep the market in a bear market longer, for longer, if the banks are really, really weak. I don't think that that's a good sign for the market. For now, they're basically right around the lows of where they were last week, but I would keep an eye on this. Perhaps something is going to, if this really begins to break down, I just don't think it's a great sign to see the banks break down. Now that's not what we have right this second, but we're getting close to that. Also a lot of just the higher quality names, I've been kind of positioning in more stronger earnings, higher quality names. Those just didn't seem like they had any momentum to them. Even in the beginning of the day, I think some of them were up a little bit. Of course, there's some outliers in there, but take for example what biotech did today. It was up 1.6% today. It wasn't that big of a move, but again, it just wasn't screaming. It had a nice recovery, by the way. They just kind of seem like they're stuck in the mud. And this is the equally weighted biotech ETF. I'll continue to follow it, and maybe you can get moving, but but things like this are looking interesting. PODD, right, was up 4% today, right? Nice green bar. The CPRX continues to stay hot. That was up 2.2%. Very similar looking chart to me is this Target Hospitality. Even though this was down on the day, it's a good looking chart. Here's what I did today. I'm going to go through a couple of my names. Again, not a big mover, you know, but which is fine. These are the things that I wanted to own into this event-driven week. But, you know, I took targets, right? This was calls that we saw yesterday in GSK. I took a target in that. UCTT, which is a semi name, took that. Ryder was a name that I added yesterday. I got out of that name today. Took my last target here, but you could see target. Took this hedge off for today. I actually could have kept it on a little bit longer, but again, I don't, if I'm reducing exposure, then I don't need the hedge, right? The hedge is an insurance policy, in which I've talked about in the beginning of the week, you know, how I had a hedge for this week, right? The one trade that I did take a little bit after the open, I got stopped out in. Right. And then I just continue to take profits in some other names. And that's it. Like, I really didn't trade that much. You know, again, I look at risk first, and I don't really have a lot of edge knowing what, you know, I don't know what Powell's going to say tomorrow. So, you know, like I said yesterday, I think the expression that I used in yesterday's video was a bird in the hand was worth two in the CPI, right? So, you know, yesterday made money, today made money, right? And certainly didn't push it, you know, trying to trade, and, you know, after we had a huge gap up today, right? Again, just knowing where there's edge and alpha in the market versus where there's not. I did add, because I'm really down to like pretty low exposure at this point. I did add EMR, which we saw some calls in this one. This is an industrial name. Now, the only thing I don't like is this VPOC up here, but I like the pop out of the consolidation. Right. And if that continues, if we look at this on the weekly chart, you might have a nice breakout here in Emerson Electric, right? And again, you know, I'm doing this now in every situation because of the overall level and interest rates, but it's not a cheap name, right? The PEs are around an 18, 19, which I think is kind of like in line with the industrial group. But so this is diversified industrials. So I went long that name. You know, I've got a couple other names that I'm watching, but, you know, Sarepta is a name that I remain long. I did not take a target in this one today, even though it was up. You know, we'll see if this thing can maybe go ahead and take out those recent highs. But you know, that's it. You know, I think maybe this will set up, you know, depending on what Powell says tomorrow, right? We go over charts every single day. That doesn't mean that we have to do a huge amount of trading, you know, every day, or adding new positions, right? Sometimes sitting on your hands, believe it or not, you know, could be the best thing for the particular day, right? So I think, you know, that's important. I don't talk about that, you know, every one of these videos, about having patience and not having to, you know, if you don't find the trades right away that day, sometimes they're just not there. And, you know, it's better to be patient, especially when you've got a lot of big events like this. And the other thing too, in this market where, you know, I talked about how we haven't, the indices haven't gone anywhere in 5 weeks, you know, that's a tough situation. And that's, in my opinion, you don't want to be greedy, right? In those situations where we're going sideways, right? A lot of base hits and a lot of doubles versus home runs. All right, guys, thanks for watching. Have a great night, and see you tomorrow.